Britain's new government says that growth is now the UK's national mission. But how optimistic should that make investors? Welcome to Market Insight, I'm Thomas Warner. Britain's Labour Party swept to power last Thursday, promising to stimulate a flatlining economy. Since then, the new finance minister has revealed plans to relax planning laws to try and boost building. But former Bank of England chief economist Andy Haldane said on Tuesday that something, quote, more striking and radical is needed. Well, with me to give his take on what investors should make of the new government and its plans is James Smith, developed markets economist at ING. James, very, very good to have you on. Thanks very much indeed for your time. Before we look in any detail at those plans, give us some context. What do you think the challenges are facing this new government?
Well, growth is clearly the number one priority. The government has made that its big thing in the campaign as well. I think one of the key focuses is on investment. If you go back to the aftermath of the Brexit referendum, the UK was consistently underperforming when it came to business investment, the political drama, the uncertainty about the future relationship with the EU. But the UK lost several years in terms of investment. And I think that's really the key thing, playing catch up there, be it on public investment in infrastructure, but also unlocking more private investment. It's going to be a big challenge. The good news, at least for the new Labour government, is the economy is already looking a little bit better. We had some really good first quarter GDP figures this year. The UK economy is bouncing back after that technical recession at the end of the last year. So a bit of a better starting point, but clearly a big long-term challenge.
And we have already had some quite significant measures announced on the planning side, James. What do you think those really mean in practice?
Well, that's right. And, I mentioned the political instability over the last few years. Clearly, that's been a big break on investment. But I think the planning system is often widely cited as a big problem as well. If you look at some of the big infrastructure projects of the last few years, high-speed rail, you look at the energy system in the UK, big delays getting connections of offshore wind to the electricity grid. It all comes back to planning. It means that UK infrastructure projects often take much longer than in Europe, but end up being much more expensive as well. So there's a big prize here, both in terms of infrastructure, but also housing, a big issue in the UK as well. So it's a big challenge. The bigger short-term issue, though, is that not so much whether the growth can be created, but more about what the Office for Budget Responsibility makes of it. That's sort of like policeman, if you like, for the public finances. They judge how much money the new government has to spend or reduce taxes by. And it's already very tight. The OBR's growth forecasts already look quite optimistic. They'll be hoping that those new sort of pledges on planning will convince them to upgrade the growth forecast even further, but I think that looks quite unlikely. So the reality of the public finances in the short term is still quite a tight backdrop.
I have the impression from what you're saying, James, that you actually believe that changes to the planning system may actually be sufficient to make quite a big difference.
I think they could, but I think it is going to take a few years, right? I think these things take time. It's enormously complicated to change the planning system. I think people are very good at pointing out the problems with it, but the solutions are much harder. A lot of it is intertwined with environmental regulations, the UK's commitments on net zero. All of this plays a role. So it's very difficult. It's very long term. And I think that's why many economists, myself included, think that if the growth can't be delivered quickly to sort of improve the public finances, Labour is going to have to look more seriously at sort of tax rises, more so than what it's pledged during the campaign.
Now, James, we do have the subject of the Bank of England to deal with. Interest rate cuts have been on the agenda for a while now. According to a piece that you wrote recently, you're expecting a cut in August and then 2 more to follow. Do you hold to that forecast?
Yeah, I do. And actually, the election makes very little difference to this because in the short term, at least, the new Labour government isn't promising to do anything radical on tax or spending. If it was doing that, then maybe that would feed into the Bank of England's decision. But we're certainly not going to get the first budget for at least 10 weeks. So that leaves things clear for the August meeting. The sort of main sort of thorn here, if you like, is that services inflation, which is the number one thing the Bank of England's been looking at. That's been quite stubborn recently. That has been down to a few one-offs, and the Bank of England has accepted that. So it does feel like we're on track for that August rate cut. And if you don't believe me, just listen to what the bank itself is saying. Andrew Bailey, the governor back in May, was saying they could end up cutting rates further than markets expect. So it certainly feels like them themselves are gearing up to this rate cut over the summer. And yeah, I think probably a couple more thereafter.
Let's imagine that we did get 3 between now and the end of the year. What kind of stimulus do you think that would actually provide?
Well, it's interesting because a lot of the stimulus or the effective interest rates come through the mortgage market. And it's a very different picture compared to sort of 10, 15 years ago, where the vast majority of mortgages back then were on variable rates. The effective interest rates was much more sudden. These days, 90% of mortgages are fixed, typically for 2 or 5 years. It does take time for those rate cuts to come through. Sorry, in fact, we're only still feeling the impact of those past rate hikes in terms of the mortgage market. So yes, it will be stimulative eventually. It could be, if markets really buy into the idea of rate cuts going above and beyond what's already priced, then that also offers a bit of a stimulus. But it's worth remembering the structure of the UK mortgage market, the way those interest rates work, has significantly changed.
One thing that could affect things in the shorter term would be contagion from the Eurozone. Obviously, that would be a bit of a worst case scenario, but we do have a hung parliament in France. What sort of a risk do you think that presents to UK PLC?
I think the main question in France is, if and if so, how long it takes to build a form of coalition in the French Parliament, and then what that implies for the French budget plans. I think most people are assuming that that's going to take quite a long time, and therefore, dealing with some of the tricky issues, arguably the French public finance backdrop is even more challenging than here in the UK. I think it's going to take time. I think paralysis is probably the word for some time. The main impact, I suppose, is on the currency. We've already seen the euro weaken against the pound at points over the last few weeks as that sort of French risk has come through. I think otherwise the impact for now is probably fairly limited elsewhere in the UK.
Developed markets economist at ING, James Smith, many thanks for your thoughts. And that is Market Insight. Don't forget you can watch more videos on Reuters.com.